Welcome to this video on a straightforward, low-fee retirement portfolio you can actually live with. First, we will set the stage with why fees matter so much in retirement. Then, we will explore a simple two-fund solution designed for retirees who rely minimally on their investment portfolio, typically withdrawing less than 2% per year. Next, we will discuss a slightly controversial yet practical twist for choosing a target date fund that helps combat inflation. Finally, we will cover crucial tax considerations and give you a step-by-step plan to consolidate and reduce fees without triggering unnecessary taxes. Let's begin. Before we proceed, a quick but essential disclaimer. This content is for educational purposes only and does not constitute personalized financial, investment, or tax advice. Individual situations, risk tolerances, time horizons, and tax profiles vary widely, and you should consult a qualified professional before implementing any strategy. With that established, let's move into today's agenda so you know exactly what to expect. Here is our roadmap for the session. First, we will cover why costs are critical during retirement. Second, we will walk through the two-fund solution using a cash bucket and a target date fund. Third, we will explore the controversial tilt of choosing a later target date. Fourth, we will address a crucial tax warning to avoid triggering capital gains unintentionally. Fifth, we will provide a step-by-step consolidation plan. Sixth, we will outline the risks, caveats, and who this approach serves best. Finally, we will close with key takeaways and a short quiz to reinforce learning. Let's start with fees. In retirement, priorities shift from aggressive growth to preserving capital and controlling risk, especially when essential expenses are covered by pensions or Social Security. Because expected returns are typically lower for conservative portfolios, fees consume a relatively larger portion of your gains. Consequently, shaving even 0.5% in expenses can translate into tens or hundreds of thousands of dollars over a long retirement. In other words, capturing market returns efficiently becomes more important than trying to outguess the market. With that in mind, let's transition to the simple two-fund approach that keeps costs low and oversight minimal. The two-fund solution uses a bucket framework to separate short-term spending from long-term investing. 10% of the total portfolio is allocated to a cash bucket, ideally in a low-cost U.S. Treasury money market fund or short-term Treasury bills. This is intended to cover 3 to 5 years of planned withdrawals or emergencies, providing psychological comfort and operational flexibility. The remaining 90% goes into a single, ultra-low-cost target date fund. This fund provides broad global diversification across stocks and bonds and handles rebalancing automatically. The combination seeks to minimize complexity, reduce fees, and limit the need for ongoing oversight, while reducing the risk of selling long-term assets during market stress. Now that you see the structure, let's visualize the allocation. This pie chart shows the portfolio split at a glance: 10% in the cash bucket and 90% in the target date fund. The cash portion is meant for near-term withdrawals and emergency needs, while the larger slice represents the core growth engine with built-in diversification and rebalancing. With the picture in mind, let's check your understanding with a quick question. Question: what is the suggested split for the two-fund solution in this strategies? Options are A. 5% cash and 95% target date fund. B. 10% cash and 90% target date fund. C. 20% cash and 80% target date fund. Or D. 50% cash and 50% target date fund. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 10% cash and 90% in the target date fund. This preserves a multi-year cash buffer for spending while keeping the bulk of the assets efficiently invested for long-term growth and diversification. Now, let's discuss how to choose the actual target date fund. When choosing the target date fund, a default approach is to select a low-cost, globally diversified option from a reputable provider. Typically, conservative retirees might choose a fund matching the current year or an already retired vintage. However, a slightly controversial but calculated twist is to select a target date approximately 10 to 15 years past the current year. This keeps the equity allocation somewhat higher than the most conservative glide path, which can improve the odds of maintaining purchasing power against inflation over a multi-decade retirement. The intent is not to chase returns or take undue risk, but to strike a balance between simplicity, low cost, and the need to offset inflation. Next, let's test your understanding with a quick quiz. Question: To better protect purchasing power, this strategy suggests selecting a target date fund with a target year, that is, which of the following options are: A. Exactly the current year, B. 5 years before the current year, C. 10 to 15 years past the current year, or D. The year you were born. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 10 to 15 years past the current year. Selecting a slightly later dated fund generally preserves a higher equity allocation, which can help protect purchasing power against inflation over time. This is a calculated tilt, not a mandate, and should be aligned with your personal risk tolerance and time horizon. Now let's compare the impact of high fees versus a low-cost approach. On the left is a high-fee, high-complexity setup, often including advisor fees near 1 to 2%, multiple overlapping funds, and occasional active bets that can be tax inefficient in taxable accounts. These layers frequently require ongoing oversight and can lead to inconsistent outcomes net of fees. On the right is a low-cost configuration using an ultra-low-cost target date fund and a cash bucket. This approach aims to capture broad market returns cost-effectively, minimize complexity, and reduce time commitments. While no approach is perfect, controlling costs and complexity often improves the reliability of outcomes, especially when withdrawals are modest. With that contrast established, let's quantify the impact of fees with a simple example. This table illustrates a hypothetical comparison. Using a 4% gross annual return with a 0.75% fee, the net return is approximately 3.25%. Producing an ending value near $1.896 million after 20 years on an initial $1 million. With a 0.10% fee, the net is roughly 3.90%, leading to approximately $2.15 million. The difference approaches $250,000, and this is before considering taxes or behavioral errors. These are rough estimates, not guarantees. Now, before you rush to consolidate, we must address a crucial tax warning. Here is the critical tax issue. Moving or selling investments inside tax-advantaged accounts, such as traditional IRAs or Roth IRAs, is typically tax-free. However, selling appreciated funds in a taxable brokerage account will generally trigger capital gains taxes immediately. Therefore, a tax analysis should precede any sale in taxable accounts. Evaluate cost basis lots, holding periods, current year tax bracket, capital gains rates, and potential timing strategies. With that caution in mind, let's walk through a step-by-step consolidation process to reduce costs prudently. Follow these steps to consolidate intelligently. First, inventory all accounts and holdings, including expense ratios and unrealized gains or losses. Second, transfer accounts to a low-cost custodian using in-kind transfers where possible to avoid forcing taxable sales. Third, reduce fees inside IRAs first, since you can sell and repurchase low-cost alternatives without tax consequences. Fourth, for taxable accounts, consider tax loss harvesting and spreading sales across multiple years if embedded gains are large. Fifth, replace expensive funds with low-cost index funds or a target date fund while paying attention to wash sale rules if applicable. Sixth, establish the 10% cash bucket in Treasury instruments and set dividends or interest to flow into cash to maintain the buffer. Finally, automate contributions, withdrawals, and rebalancing, and schedule a yearly review to confirm that the plan still fits your needs. Next, let's visualize the tax-aware flow. This flowchart separates the process for IRAs and taxable accounts. In IRAs, you can usually sell high-fee holdings and buy a low-cost target date fund without incurring current taxes. In taxable accounts, first check cost basis. If you have losses, consider harvesting them while moving to lower-cost funds. If you have gains, plan the sales across multiple tax years and evaluate your tax bracket. The process ends with establishing the 10% cash bucket and setting up automation. Now, to give you a sense of timing, let's look at a simple 90-day implementation timeline. This timeline offers a practical cadence. In the first 2 weeks, inventory holdings and submit transfer requests. In weeks 3 through 5, complete in-kind transfers to the new custodian. In weeks 6 through 8, reallocate IRA assets into the low-cost target date fund. In weeks 9 through 11, conduct taxable account analysis and execute phased sales to control capital gains. By week 12, establish the 10% cash bucket and set up automation for deposits, withdrawals, and rebalancing. Thereafter, conduct an annual review. Next, a quick quiz on taxes. Question: selling a high-cost fund with gains in a taxable brokerage account generally triggers what? Options are A. No taxes at all, B. Capital gains taxes, C. Early withdrawal penalties, or D. Required minimum distributions. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is capital gains taxes. Realizing gains in taxable accounts will generally create a current tax bill. By contrast, trades within IRAs or Roth IRAs typically do not generate current taxes. With the tax aspects covered, let's highlight risks and caveats. No strategy is risk-free. A later-dated target date fund will usually hold more equities, which raises market volatility. Ensure the allocation fits your personal risk tolerance and income needs. Sequence risk remains a concern in early retirement, and while the cash bucket provides a buffer, it does not eliminate the risk of poor returns early in retirement. Cash yields and money market rates can change, so periodically review your instruments. Behavioral discipline is essential. Avoid abandoning the approach during market turbulence. Finally, this strategy is most suitable when you need less than approximately 2% of your portfolio per year, because a small withdrawal rate supports a larger long-term growth allocation while maintaining safety through the cash bucket. Now, let's specify who this is for. This approach serves retirees whose essential spending is already covered by pensions or Social Security, and who expect to draw less than roughly 2% per year from their investment portfolio. It is particularly helpful for those who value low fees, minimal oversight, and simplicity, and who prefer a set it and monitor approach rather than active management. If you rely heavily on your portfolio for income, or have a high withdrawal rate, you may need a more conservative or customized allocation. With FIT defined, let's recap the key points. The key takeaways are straightforward. First, fees matter greatly when expected returns are modest. Second, the two-fund solution uses a 10% cash bucket and a 90% low-cost target date fund. Third, a later-dated target date fund can help preserve purchasing power against inflation, if appropriate for your risk tolerance. Fourth, make changes inside IRAs first to avoid current taxes, and plan taxable moves carefully to minimize capital gains. Fifth, automate as much as possible and schedule annual reviews. Lastly, this strategy best fits those with low withdrawal needs from their portfolios. To conclude, control what you can control: costs, simplicity, and discipline. Separate safety from growth by using a dedicated cash buffer and a comprehensive target date fund. Consider a slightly later dated TDF to guard purchasing power, provided it fits your risk profile. Respect tax consequences by prioritizing changes inside IRAs and handling taxable accounts with care. Implement the plan over a manageable timeline, automate, and then monitor with an annual review. Finally, let's close with a quick thank you and a request to engage with the channel. Thanks for watching. If you found this valuable, please like the video, share it with someone nearing retirement who might benefit, and subscribe for more practical strategies. Tell us in the comments how you would tailor the cash bucket and which target date you would choose. Your input helps others learn, and it helps shape future content.